my mandate from clients is that I manage their entire portfolio. It's a multi-asset strategy, right? So I have to have exposure to the broad market, and typically we do this through custom passive strategies, through index funds, and really to save on fees. But I think investors should be thinking about three things, right, in terms of how to navigate markets right now. Number one, perspective, right? So you have to understand that we were in an event-driven recession. And what the event taketh away, right, in this case, it was growth, economic growth, it will also giveth back, right? And we're seeing that right now. But this time we have an expiration date on this event, right? And the second thing is plan. Is your plan to be a trader or is it to be a long-term investor? Right? And so
he's not a trader.
Investor. My clients are
he's a
institutions.
long-term investor, right? He's a long-term investor.
No.
And to your point, though, you're right. You're right. Right? It was an event-driven recession. You're going to come out of that. What also comes with that, as part of his point, higher rates, reflation trade. So the market is going to react accordingly to that.
It will, but let me just finish my point, right? So when you have a plan, right, and in this case, I'm a long-term investor, and understanding what's going on in the markets right now is a moment and it will pass. And really understanding the third thing, positioning, right? And having a diversified portfolio is particularly important for a time like this, right? So it's not a question of growth versus value, S&P versus NASDAQ. For me right now, you need to have both. You need to have a diversified portfolio. That's how you weather the markets.
Josh Brown, I mean, this was a call that the value renaissance, which some investors have been calling for the last however many eternities, is finally here. And he wants investors to be positioned accordingly. Reflation trade, rates go up, multiples get compressed, and those left for dead value stocks finally have their day. What's your thought?
With all due respect to John, I think the critical part of this is what do you do about it? And I disagree with his answer. I don't think the S&P 500 is where people really get hurt and what you want to avoid. I think it's the Russell 1000 growth or the NASDAQ 100. That's really where the excesses are. Because if there is a value renaissance, the S&P 500 will do just fine. Plenty of stocks in the S&P 500 are what you would consider to be value stocks, and it's highly diversified. Even though 20-some-odd% of it is technology, you've got all of the other value sectors in there. So John's a value investor. It's always a value renaissance about to happen for value investors. And you can always find value if that's your discipline. Concentrated, value-oriented, contrarian portfolios. For most investors, I think they want both growth and value. Lebenthal mentioned earlier that there are growth stocks trading at reasonable valuations currently, and that's true. He also said some of them are in the FANG group, and that's also true. I think Alphabet's a great case in point. So I think we're in the midst of a market-wide correction right now. I think it's healthy. I think it's overdue. A lot of areas of excess are you're seeing this multiple compression happen live in real time, and I think it's also been overdue. But I don't think that equates to run away from the S&P 500. If you think about where the biggest excesses are, you look at the Russell 1000. These are gigantic stocks that have egregious valuations that are not even in the S&P yet. Vroom, PagerDuty, Zillow, Okta, Datadog, StoneCo, The Trade Desk. These are the types of stocks I think John is referring to. They're not in the S&P. Many of them won't be for a long time.
He directly referenced the FANG stocks,
at least another year.
I'm not making it up. I mean, he said FANG stocks, not me. I'm not assuming, insinuating in any way, right? He said, do you think FANG stocks, Josh, are vulnerable?
So that's the part I disagree with him on.
Ex-Alphabet?
I think some of them traded premium multiples to the market, but I think we've also made the point on the show that they have for a long time and that it's deserved. I'd also point out that this idea that you're going to get this massive multiple compression as rates rise for the best companies in the world, that's already been proven wrong. We saw a rate hike cycle that got underway in earnest in 2013, and rates rose right on through 2018. They rose slowly. It started with a taper. Then it started with Fed funds rate hikes. I think we had 7 of them in total. We had 3-17 and 4-18. And you saw the FANG stocks do incredibly well, far outpacing the overall market. So I don't think it's as simple as saying multiples will contract for FANG stocks because rates are going up. I do think there will be multiple contraction in a lot of areas in the market where you've got stocks trading at 40, 50, and even 60 times sales. I don't think that's an issue for Apple shareholders. So I think John and I agree on the big picture. I think we disagree with what you do as far as like the execution of how you react to that big picture.